Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka, and my colleague.
Hello there, I'm Yatin Mutha.
Well, Yatin, what an explosive start to the week, and it was anticipated, yes, right? Given the kind of sell-off that we've seen on Wall Street. You know, two back-to-back sessions of over 1,500-point loss on the Dow. That's a first ever.
Correct.
And of course, we are fearing, redux of Black Monday on Wall Street, given the fact that even the US futures, as we speak, are down somewhere around 3.5 to 4%. Asian markets took it on the chin as well. We saw the Nikkei, in fact, entering the bear market territory. Hang Seng, a 13% drop for Hang Seng. All the Asian markets trading with deep cuts. Tariff tremors really playing out. But, look at our markets. Of course, we started on the back foot, knee-jerk reaction there. We saw the Nifty plunge by 1,000 points. But good to see that we did pull back slightly in the last 40-45 minutes of trade. So, if you talk about 3.5% kind of a cut for our markets in comparison with a 13% on Hang Seng, you wouldn't really, be complaining that much, so to say. And for us, effectively, the tariff impact was really felt Friday onward. So last week we, shaved off somewhere around 3% or so, and today another 3%. So all in all, we've seen a 6% cut on the market, wherein other Asian markets have really taken it on the chin. Even Nasdaq, for that matter, Yatin, has entered bear market zone, 22% off its 52-week high. But for us, I think technology stocks did pull back after a steep correction. Metals were among the big laggards today, but even they managed to pare some of the losses. At one point, the Nifty metal index was down almost 9%. Yes. But in the end, it ended with cuts of somewhere around 6% or so. So nothing really to complain about as such. Of course, 20 lakh crore rupees wiped off from the market today in market capitalization. So yes, worrisome, bothersome, but whether or not we've seen the worst of it, that question is still out there. But Yatin, broader end of the markets, even there we saw deep cuts.
Deep cuts, almost 4% down for the mid and small cap indices. And if you look at the advance decline ratio today, despite the fact that we recovered quite smartly intraday trade in the last half an hour, but the advance decline ratio, if you look at it, it was almost 1:20. So quite weak on that front. When it comes to the metal index, real estate, media index, a lot of losers from that front. Broadly, we had stocks like Trent after quarterly updates with lower growth than expectations. The stock was down 18% intraday, settled almost 15% lower. Stocks like Jindal Saw, Wockhardt Pharma, Mazgaon Dock, wherein there was a government OFS that fell below the floor price of 2525 to end the day close to 2,300 bucks. We had Nalco, Sobha Developers, JM Finance, Tata Steel, all of these stocks falling in trade, and especially the Tata Group companies. The 6 Tata Group companies in the Nifty have seen market cap erosion of almost 1 lakh crores intraday. And we also had the entire month of April so far, which is almost 3-4 trading sessions, wherein the Tata Group, which is one of the globalized conglomerates here in India, which has seen almost a 2.5 lakh crore kind of a market cap loss, with TCS leading almost 50% of the losses for the group, with nearly 130,000 crores in losses for the market capitalization.
Sure. I think, some FMCG names, did show resilience today. Talk about HUL, that was the only gainer on the index today. But even the likes of Zomato, Nestle, all the other consumption names like Asian Paints, ITC, Maruti also, managed to kind of, weather the storm pretty well. But how should one really be navigating this leg of tariff-induced sell-off? Let's understand, and get some opinions to help our viewers understand really what to do in this kind of a market. Let me bring on board Ajay, Bagga, big market voice, joining in this afternoon. Ajay, lovely having you on the show here. But, want to get in your thoughts on, what's transpired on the tariff front. Of course, it was harsher than expected, 26% for India. Talks are on the table. But, how are you really viewing this entire picture? Do you see some bit of rollback coming in before 10th of April? Or would you say that, it looks bleak and things are going to roll on the way they are right now?
Well, right now markets are factoring in that it looks bleak, and this morning the snippet of Trump boarding Air Force One and saying sometimes medicine has to be taken, that really set off the markets. So overall right now markets are factoring in that these tariffs stay at the level they are. They will have a detrimental effect on raising inflation, reducing global growth. reducing global trade, and will also impact the exporting nations' economies. So the overall impact on global growth is more than $1.5 trillion. If you look at global GDP, it's about $105 trillion a year, out of which global trade is $33 trillion. Of that, the US imports of goods is 3.3 trillion. So you would have thought that a small portion on 3.3 trillion won't have that big an impact on the entire global GDP, but there are cascading effects, and it's leading to various other second order, third order effects that the markets are factoring in. So about a $1.5 trillion global impact is getting factored in, and markets are reacting to that. Lesser corporate earnings on elevated valuations, and also a risk of sentiment overall, where long short funds have made massive losses, and they have been selling. Leverage positions are being cut in a rush. All that has impacted the markets, and we have seen a very furious cuts happening to global markets. India has got away relatively cheaper so far, and we had underperformed over the last 6 months. So I think our froth had been taken out right from September of last year. So we have not had, so far we have not had very sharp cuts in India, and I hope that stays.
Hi Ajay, Yatin Mota also joining in the conversation. Good to have you on the show. When you talk about India per se, be it 2008, be it the COVID crisis, be it any other crisis, we haven't seen decoupling of equities. So do you think this time again, despite the fact that the froth is off the table, we have been correcting since September, do you think there is still room for correction, or do you think valuations will be supportive with domestic mutual funds, being the buyers in the market, and FIs selling probably in absolute terms would be lower than what it used to be in the first half of this financial year? What is your overall assessment when it comes to the fund flows and the impact on Indian equities?
Yeah, Yatin, if you remove the sentimental overhang and look at the flows and the fundamentals very carefully, 18% of the US market is owned by international capital. So some of that could be removed from the US markets. Where would it get housed? Europe, Japan, emerging markets. So India has a good chance to get incremental flows. Right now, the sentiments are too spoiled. Now, does India get caught up in it? Yes, it does. We saw that in 2008. For a couple of months, the thesis was India is decoupled. We have got off lightly. And then once we got very strong correlation happening on outflows, we ended up being down nearly 60% that year in 2008. So we are very much resilient, but we are not insulated. I think that's the key word, not being insulated fully. The impact on us comes through the flows. When there are pressures or there are losses elsewhere, we have seen FIs taking money out of India to offset liquidity overhangs elsewhere in their portfolio. As we saw gold selling happen on Thursday and Friday, otherwise gold should have been bought as a safe haven buying. Silver, of course, sold off. You could explain silver that 60% of silver price is industrial growth. That's coming down, so silver is falling. But gold fell so strongly, and even today it was falling. And then Stanchart had a report out that a lot of it was margin calls on hedge funds, which were selling gold. So that's where we get caught in. Otherwise, even in 2008, 2009, we grew quite well. We did not go into a recession economy-wise. COVID, yes, because of the lockdown. We had a couple of quarters of very slow growth, but otherwise we have kept growing. And we foresee the structural India domestic story to remain. But it's the cyclical sentimental momentum which has gone down and which catches us in its snares.
Ajay, what are the chances of the US economy falling into a recession? JP Morgan says 60% chance. Earlier it was 40%. If that really happens, would you expect more Fed rate cuts to come in? Because on Friday, the Fed chairperson, said in he didn't mince words. He just said that, they are ready to stand pat on interest rates. But do you think that would force Fed to cut rates going forward?
Bond markets have been over exuberant. What we use when we came in the markets, the bond market was the most accurate predictor. Then the currencies and then the stock markets would normally follow. But bond markets have been wrong. And again, now what is happening? This time last week, bond markets in the US were pushing towards 3 rate cuts. Then around Thursday, it went to 4. And today, the overnight swaps are showing 5 rate cuts. They are showing 125 basis points baked into the US overnight curve, showing 125 basis points of cuts, which means 5 rate cuts this year. Obviously, the bond market is overreacting. 5 rate cuts seem distant. But some commentators have already started saying that ahead of the May policy, the Fed might have to make an emergency rate cut. I don't think we will get to that. Right now, the financial conditions are worsening. The sentiment is worse. You will have big banks reporting this Friday and Thursday. And I'm expecting a pretty dismal commentary from Jamie Dimon, which will be again a big catalyst down moves in the market. But overall, the hard data from US is still strong. The soft data has worsened, be it consumer sentiment or business sentiment. What last 2-3 days, the post-tariff days, have done is they've spoiled the sentiment for deal making. We are seeing private equity companies falling by 15%. The junk bond market is showing a lot of trouble. So the canaries in the mine have started telling you that there is trouble coming. So looks like a recession. Now, will the Fed act first or will it hold pat? That remains a very big question. Normally, what has happened because their models broke down after the COVID intervention, they have become very data dependent. They were very late in raising the rates after inflation.
Right. Ajay, in the context of, whatever is happening globally, be it the US Federal Reserve action or the EU, response to US tariffs, where does India stand, in terms of economy, in terms of growth, in terms of RBI rate cuts? Because before the, Trump tariff announcement, we had the economists which were baking in a 0.5%, rate cut from the RBI for 2025. So do you think the Federal Reserve move for rate cut would also force RBI to take higher than expected rate cuts for 2025 calendar year? And in terms of recession in the US, does that mean a slower Indian economy wherein we have already revised our GDP growth to less than 6.5% for the current financial year? So how do you see Indian growth rate cuts shaping up in between all of these noises in the global market?
Yeah, as far as our rate cuts go, the RBI has done an excellent job in injecting liquidity, and post the last rate cut, they have done macroprudential easing as well. So they have a lot of weapons in their armory. We are expecting a 25 basis point rate cut on Wednesday, and at least 2 more rate cuts in the rest of the year should come through by the RBI. The Fed will cut from June onwards, if not earlier, and maybe 3 rate cuts from the Fed. So that monetary space is there. What happens to the Indian economy? The domestic part is doing well, and the infrastructure build out will continue. What will get constrained is the external part. So out of the 4 pillars, consumption is boringly going up, but there is no stimulus per se. The tax cut on the margin is too small to move the needle on an economy the size of India. What is needed? I think rapid GST rate cuts, rapid tax cuts, and putting some stimulus into some targeted industries. That will help revive economic growth on a fast path. I don't know if that will happen extra budgetary. Definitely next 3 months, I'm not expecting. The government is very conservative and they wait and watch for impacts before they act.
What about those export-facing sectors, Ajay? We've seen autos, react quite negatively. The likes of Tata Motors taking a direct hit as a result of the 25% auto tariffs, and even auto part makers. How are you looking at these sectors now? Even metals, for that matter. Slowdown concerns have taken a toll. IT, of course, if there is a recession, then the recovery that IT was really baking in, gets delayed further. How are you really looking at these sectors now?
Yeah, external sectors will suffer in a US slowdown. IT is very strongly correlated to US economic growth. So order wins reduce, margins get compressed, new initiatives get postponed by US corporates. So that will hit. And our IT majors have anything from 60 to 80% of revenues coming from the US. So already artificial intelligence was pressurizing them. Now we have a US slowdown also coming in. As far as the goods exporters go, protectionism will hurt them. So on an 83 billion exposure, you can expect sectors like seafood and auto ancillaries immediately get impacted. They don't have those margins. Sectors that are more consumer facing have margins. We'll have to see. Electronics again have very tight margins. So there it will be a game of comparatively lesser tariffs than China or Vietnam or Cambodia, Malaysia, Indonesia. So will we get some relief there? Textiles has the margins theoretically. We'll have to see if they gain some market share, but it's a no-go zone. Those exporters remain a no-go zone unless there is a rollback, unless there is a postponement by the Trump administration, which will then give a chance for the market growth. Otherwise, fishing within that market itself and trying to gain market share, it's a fool's job. Sooner or later, even if you're successful, the US will hike the tariffs on you, and otherwise you would have done a lot of other damage. So I would not go towards these export-oriented sectors for now. The situation is not conducive to fresh investments.
Sure. So, which are the sectors that would be largely unscathed? And if you look at this sell-off as an opportunity to accumulate, some of the stocks in particular sectors, domestic-facing themes, so to say, which ones would you really look at now, Ajay?
Domestic themes like FMCG, consumer durables, banking, financials, and other infrastructure players who are largely concentrated on the India infra, who don't have order books from, say, the Gulf or from the US. Now, order books will also get impacted if the crude oil stays where it is. Your Gulf order books will be impacted. All those second order effects will slowly creep in. China will probably depreciate its currency. The RBI will have to depreciate the rupee as well. So we'll have to be careful on that. Metals is a no-go zone, again, because of the Chinese slowdown. The property sector has not recovered, and we are seeing a sharp correction in metals. So despite our companies being very well-run, tight ships, because of the global overhang, pricing will be difficult, and we'll have to protect ourselves from Chinese dumping. So all that excess Chinese capacity will try to find a way to get into India through various FTAs. Already we saw the Thailand FTA leading to a lot of dumping into India. So as we go forward with 7, 8 more FTAs, we'll have to watch out for Chinese goods coming into India with a transshipment and showing as if they are made in some other country.
Point taken, Ajay. With that, we're running out of time. Would like to thank you for taking our time and joining in this afternoon. Look forward to more conversations. As the situation remains fluid, we will be touching base with you soon again and getting you on the show as well.
Thank you very much. Thank you.
Thank you. Well, with that, of course, we've come to the end of closing bell, but all eyes on the US market open,
Absolutely.
Yatin. Is it going to be a redux of the Black Monday that everybody is fearing, or how is it going to really pan out? And if there's another comment coming in from Trump, of course, we will be reacting to that as well. But let's hope it's something positive, some kind of deal with some nation.
Yes, actually, Nandita, we had the Japanese market, Hang Seng, China, all of these indices fall too much in intraday trade. Trading was suspended, in few of the nations, but there was a recovery intraday. Dow futures also have seen a recovery from the day's low. The European markets have recovered almost 3-4% from the day's low. So obviously, the hope would be that Europe and US recover. We open with a strong footing tomorrow because 22,000 is the level on the Nifty wherein we saw good support today. We bounced nearly 200 points from that level. And obviously, the Indian government has been communicating with the media that they will negotiate a few FTAs and trade agreements with several nations, including EU as well as US in the short term. So, is that short term 3 months, 6 months? We don't know. But yes, the government is quite aggressive. And today on CNBC Awaaz, one of our reporters reported that Wednesday is the cabinet meeting wherein the top agenda would be the trade war and the implications of the trade deals that we do with other countries, how to take the trade war situation forward, something that the cabinet will be talking about on Wednesday. So the hopes are that the government is on a very strong footing, ready to talk on with the trade deals with several nations. Hopeful that there will be some resolution or some
bit of a rollback,
some light at the end of the tunnel in the shorter term.
Well, let's hope so. And before that April 10th deadline, when the tariffs actually take effect, let's see if something can be thrashed out or not. And White House has already said that 50 nations are making a beeline, over 50 nations are making a beeline to thrash out deals with the US. So one headline, one positive headline, I think the market worldwide is really waiting for that. But with that hope, we are ending the show today, Monday evening. Of course, tomorrow is another day. Let's see what kind of cues we get from the global markets. But for now, from Yatin and me, thanks a lot for tuning in. Have a good evening and come back and join us tomorrow morning once again with opening bell at 9 a.m. Thank you.